Caught in the crossfire of an escalating price war, Toyota Motors' joint venture with Guangzhou Automobile Group in China is grappling with severe market pressures. The venture's decision to terminate contracts of 1,000 workers prematurely underlines the mounting challenges it faces in the world's largest auto market. This deep dive reveals how these stark realities are reshaping the landscape for foreign automakers in China, amid a swift transition to electric vehicles and growing dominance of local brands. Uncover the strategic maneuvers and the hard choices these industry titans are making in their bid to secure their foothold in this fiercely competitive market. In the face of an intensifying price war within China's automotive sector, the largest of its kind globally, Toyota Motors' joint venture with the government-owned Guangzhou Automobile Group has been forced to navigate challenging business circumstances. This notable reduction in personnel serves as a stark demonstration of the wider economic pressures faced by automotive manufacturers in China, a market marked by its rigorous competition and complex business dynamics. Confronted with a fiercely competitive automotive market, the joint venture between Toyota Motor and Guangzhou Automobile Group in China has found it necessary to make a tough decision: the early termination of contracts for about 1,000 workers. These employees, hired indirectly through labor service companies, were assigned to the factory located in Guangzhou. Despite the sudden ending of their contracts, the company remains dedicated to upholding local labor laws by providing the appropriate financial compensation to the affected individuals. This situation emphasizes both the harsh realities of China's automotive industry and the firm's unwavering commitment to ethical labor practices. Toyota's choice to reduce its workforce in China resonates with a comparable approach adopted by Mitsubishi Motors, another significant player from Japan's automobile industry. In an earlier instance, Mitsubishi Motors endeavored to curtail staffing expenses at its joint venture with the Guangzhou Automobile Group as part of its strategic response to the demanding circumstances in China's automotive sector. Both Japanese companies are grappling with harsh market conditions, encompassing an aggressive price war and a swift market shift towards electric vehicles, posing serious threats to their profitability. These reductions in workforce underscore the escalating hurdles that foreign automakers are facing in securing their presence in the world's largest auto market. Japanese automakers, Toyota included, are currently facing considerable challenges in China, manifested in their significantly diminished market share. In a span of merely a year, their stake has dropped from close to 20% to 14.9%, indicating a substantial alteration in consumer preference. In stark contrast, domestic Chinese brands have been able to amplify their market dominance considerably, now accounting for 53% of the total sales. Contributing factors to this shift could include Japanese brands' slower progression towards electric vehicles and rivals' aggressive pricing strategies. This evolving trend underscores the enhanced competitiveness of Chinese brands in the world's largest auto market, affecting the operational performance of foreign manufacturers. In spite of Toyota's concerted efforts to invigorate its sales in China through significant price reductions of its BZ4X electric vehicle model, the company is confronting a decline in sales. A key contributing factor appears to be Toyota's somewhat delayed shift to electric vehicles relative to its competitors, a factor that is impacting its market competitiveness. However, this is not a challenge unique to Toyota, but it mirrors a wider shift in consumer preference away from Japanese car brands towards competitors such as Tesla and BYD Company, who have been faster in adapting to the EV revolution. This situation underlines the pivotal importance of innovation and nimble adaptation in preserving a competitive advantage in the swiftly evolving automotive industry. In conclusion, Toyota's strategic workforce reduction in China reflects the broader challenges automakers face in a rapidly evolving market, highlighting the need for quick adaptation and innovative approaches to remain competitive.